You say, look, we're I don't know if you used the word cusp, but you know, it felt like you were saying we could be on the cusp of a recession. If you look at the markets, are they behaving the way they should be?
We are 2.9% global growth is where we are. Recession somewhere close to 2.6%. So we have a little bit of buffer. The hope is that and our forecast, base case forecasts are that in Q2 we will see a decent rebound in global growth. So we're not forecasting a recession. But if this was to persist into Q2, then of course we will go into recession. Across asset classes, the bond markets are telling you that we are headed there. The equity markets are not. So the base metal arena has been the one that has been hit the most. And that's telling us copper is struggling to rebound. Commodities in general, oil is struggling to rebound. Bond prices are still very, very big. Whereas equities are telling you this is a shock, we're going to look through it. So they're very sort of dissonant messages across different asset classes.
Okay, so is this because, you know, equities, it's much more difficult to price, whereas actually, you know, if China collapses or significantly slows down, then it impacts the demand for oil straight away, or is it because they're looking at Fed?
I think that they are looking at liquidity more than anything else, because if you look within equities, then some of the growth stocks, which are more sensitive to liquidity, have done much better than the value stocks. Right? The value stocks are about is our energy prices rising, our steel prices rising, our auto sales going up, and those stocks have been coming down, whereas the growth stocks, tech and liquidity-driven growth stocks, have been quite big. So I think the market is looking for much more liquidity from global central banks. You've seen Fed pricing change quite a lot, and I think that's why equities are bid.
Okay, but are they right in doing it, or is the market mispricing?
I do think that the market is mispricing. If this was to continue into Q2, equities would prove to be very wrong.
Okay, let me bring you to the chart, which we've called now the Bhanu Baweja chart. So this is thank you to Hillary Clark that brought this to my attention this morning, and it's basically the correlation between gold and the dollar, and it's a negative correlation at an 8-year low. What does that tell us?
So the fact that the correlation is not as negative as it used to be tells you that gold and dollar are moving roughly in the same direction, which doesn't typically happen, right? So typically, if this is a strong dollar environment, you'd see gold selling off. The fact that gold is rallying in this dollar environment tells you that this is not a strong dollar environment, that we should be actually thinking of this as a slightly weak renminbi, slightly weak euro environment, which are grinding weaker because the world is worried about growth in the rest of the world, right? So this is not dollar strength, this is weakness in other currencies. The subject is not the dollar. If, therefore, growth improves in the rest of the world, you will see, therefore, the dollar weaken.
But, Bhanu, this changes everything.
I do think so. I mean, I think this, look, if growth in the rest of the world, because of coronavirus, but because also other reasons that we discussed earlier, which is that you're not getting support, fiscal or monetary, from the rest of the world, if that is correct, then over the long term, that must impact the dollar cycle. The dollar is going to react. The dollar is not the exogenous variable. It's not where the story begins. Right. It's going to react to weakness in the rest of the world, and therefore it's going to be stronger over the medium term.
Okay, but so what does that mean for Fed policy?
I think the Fed will therefore have to be a little more dovish, and the market is pricing it as such. Right. So the market is already saying that it's very interesting, in fact, that after the coronavirus, the RBA, which is much closer to China, the pricing for the RBA didn't change as much as it did for the Fed. So the Fed is now pricing in close to 2 cuts, which I think is quite a lot for the rest of this year in terms of what's being priced in already. We wouldn't be receiving the front end of the US at this minute. We think Canada, Switzerland, Australia give us better opportunities to receive the front end.